Testing, testing, 1, 2, testing. Thank you. Testing. Good morning, everybody. Thank you for your patience here. I've had a couple of difficulties this morning. We got some really fast market conditions. And so please bear with me here as we adjust to this tremendous volatility. The gold market has been in a very, very choppy area here, as you can see. Pretty much, I think what we're looking at is the volatility that is essentially the struggle and the fight between the bulls and the bears at these levels here. And I am still trying to identify the anomaly that we are dealing with right now in the gold market, the silver market, in relation to the physical market, which is experiencing a shortness of supply. And the price of gold and silver coming down here, it does not make any sense at all when we're dealing with a tight supply situation. So, because the gold market in its fundamental picture has never been more bullish than what we have right now. And it keeps getting bullish based on the monetary situation that we're dealing with right now with regards to the pandemic, with regards to the stimulus, with regards to the consequences that all of this printing of money is going to have down the road. Now, I think canary in the coal mine, as they say, is interest rates. The 10-year note is at 157.8, making a new high, up about 1.83%, which signifies that the interest rate on the yield on the 10-year note is pretty close to near 160. What the market is reacting to is the fact that back in early January here, the 10-year note was roughly at about less than 1%. And we have seen that jump from 1% or under 1% to 1.60%. That means that interest rates have gone up. And most conventional wisdom will interpret a rise in interest rates bearish for precious metals, due to the possibility of a stronger economy, which could ignite much higher levels of inflation. So this is the dilemma that we're dealing with right now, in that the 10-year note is beginning to validate and confirm that all of these current monetary policies are going to be highly inflationary. And short term, the anomaly is that obviously the interpretation of a rise in short-term interest rates is causing a lot of pressure in financing just about everything in every sector, from gold to stocks to equity. So the stock market obviously is reacting to the consequences of a rise in interest rates. Now, this is the perception. This is the perception that this increase, this spike in the 10-year is bringing in the market. And what I want to do here today is talk about basically that is a misconception. If we use the 70s as a point of reference, interest rates in 1970-71, after Nixon lifted the gold standard of the U.S. dollar, and the U.S. dollar became the world's reserve currency, petrodollar, was the beginning of this tremendous inflationary spiral, or you might say creating the foundation for inflation, or for the dollar to devalue itself as a fiat currency against the measure or the backing of the gold standard that it had. Now, I want to share a story with you that keeps coming up, and I thought maybe it's meant for me to share this with you. In searching in my garage, I found, just going through my old stuff, the 70s are in the news again, and so I went back to my 70s box, so to speak, that we all keep, in terms of, I don't know, at least I do. I pack things and put them away and stuff. And sometimes you pack little things that you might want to have a reference to at some point. And I found a little box, and in that box, there was a silver dollar, a quarter, and a dime. Prior to 1971, 99.9 silver. And when I began to really kind of ponder where we are currently in this market, with this anomaly that we have, that basically the cash market is very tight. I tried calling half a dozen dealers. They don't have physical available coins available. I tried pawn shops. They're not available. They don't have it. Or if they have it, they're holding on to it. And then if you look at the value of a dime made out of silver, 99.9, that dime can buy me a gallon of gas today. In terms of silver. And this is the discrepancy that most people, I believe, fail to connect to what it's called money, real money. The US dollar is a paper fiat currency. It is not backed by anything natural resource that will maintain its intrinsic value. It is backed by the faith and trust of the U.S. government. So if you trust the government, then just keep buying dollars. And that's what most people tend to do in a situation where we have a currency crisis, which is what we're dealing with right now. A fiat currency crisis. And I'll tell you this, if we hadn't taken the gold standard off the US dollar, we wouldn't be in this situation. So what we're beginning to see, and what I'm beginning to see, is the distinction, the clear distinction of the value of what is real money. Now, the integrity of the U.S. dollar obviously is at jeopardy right now, obviously because of this tremendous pandemic crisis that we had, and we're still dealing with the effects and economic effects. I showed yesterday a video from Rob Keats, who did a tremendous research in pretty much the fundamentals behind the credit union reports that were made that are showing a staggering increase in defaults, credit defaults. People are defaulting on car loans, initially on things that they can let go. And eventually it seems that momentum now, is building up to mortgages. And unsecured loans, mortgages, credit cards, car loans. It has jumped, in some cases, 800-900%. If you take a look at my video that I did yesterday, Rob did an incredible job in pointing out the reports directly from the credit unions. We're dealing with facts, not fiction. And so what I'm seeing here is that we need to be prepared for a few black swans that I think will unfold as we move into the rest of this year. And it is my conviction, and I'm putting my money on the line, my own money on the line, my conviction that this anomaly will adjust sooner than later. And I believe the adjustment to the mean that needs to take place here, as we find that the values are tremendously skewed from its mean, are going to be violent, are going to be highly volatile. It may be in short durations, but the magnitudes are going to be astronomical. If you can visualize the price of precious metals being in a pressure cooker, and I call that the pressure cooker of manipulation. People kind of still question, where is the manipulation? Where is the manipulation? And if you take a look at the COMEX reports, and that I pointed out yesterday, in fact, for the last delivery date, before the open interest, before the delivery date, the open interest in gold was roughly, I believe, about 317,000 open contracts volume. There were 5,000 contracts to stand delivery. And the open interest went up from 317,000 to 367,000 overnight. So if you take a look at what Rob is looking at, is that if there were only 5,000 contracts waiting for delivery, why did the central bankers or JP Morgan or Goldman Sachs, that are the custodians for the silver, sold 50,000 contracts. That's a 10-to-1 ratio of paper silver that does not exist during a time of delivery of 5,000 contracts. So obviously, they drove the price down into that delivery, not only to wipe out all of the call premium from the 1800s or, above, and drove the price down to 1683, which is what the low was made here yesterday. Now, mind you, this is during the biggest deliveries in the history of the COMEX being made. There has never been more volume, more interest in taking delivery of gold and silver through the futures contract. And the reason is because you can't buy physical silver or gold without paying an incredible premium. And in silver, I believe the premiums are going $8 to $10 above the spot price, the paper price. And, so I wanted to just point out to you this kind of a mixture of details, economic details that are skewing the actual value and the mean of gold and silver. So the short sellers have succeeded in reducing the risk of their position that I think at some point they were running a risk of about $40 billion on the short side of silver. And although we saw a short-term bleep in the price up to about 30 and some change here on the Reddit raid that I call it, the beginning of the month, it looks like it put in a short-term top. And the VCPMI was anticipating those areas to be a distribution of supply. The one thing that I think it caught everybody by surprise is the velocity of the move, that it went from a low, once again, of 24 or 4 to 30, 35. Now, we're talking about a move from the 19th of January to the 1st of February. It's a couple of weeks. That's a $6 move in silver. And it caught the short side by surprise, the short sellers by surprise. But the fact that the market came up to 30, $30.35 accelerated the seasonal top to come in sooner than later. Usually it comes in around April, March or April. But this volume of new players really drove this market up to this 30-35 level. And what we saw was a dumping of supply up here. And the AI basically recommended to unload the supply. The red area that when you see it signifies pretty much resistance, or an area where you're looking at a high probability that we're going to see supply come into the market. And it did. Obviously, everybody that bought up here on Wall Street News or the Reddit crowd pretty much got clobbered. If they bought on margin, even more. So what we have seen here now, if I can come back now and analyze pretty much what I'm looking at, what the VCPMI is telling me as a self-directed trader, is that we've come in here into this area in blue, which is the extreme below the mean. The weekly mean is 2711. And on the 23rd of February here, we had a false breakout, trading about 2842, but came back down, negated this bullish uptrend here that it built, and activated a bearish trend momentum, activating the levels below, the extreme levels below the mean of the weekly 2711 were 2575 and 2479 for this week. So closing below 2807, which was the weekly short trigger that came in on the 25th of February, has completed the target of the extreme below the mean weekly. And it's come down to this area that is saying it's an area to accumulate supply. So if you were short and the market came down here, then this is the area where you want to take in your profits. And upon the market validating the supply and demand down here, we're going to see if there is more selling pressure, or what the VCPMI is telling us, that this is the area where high probability that we'll find buyers, where you got to be buying. And the trigger point, the algorithm trigger point, is a close above 2575. 2561 to 2575 would activate a weekly trigger, a daily uptrend confirmation. So this is how I identify the entry points in silver, for example. Now once I get a clear path, a clear confirmation here, for example, that the close about 2575 is activating the daily uptrend, the bullish uptrend, and the weekly buy signal, that is a harmonic alignment, is what I call. And from a mathematical point of view, it's one of the strongest relationships between the price and the momentum of the indicator. Price is the consequence of the momentum. So on silver, we're waiting for a trigger point either to come down at 2475, validate that. The low so far has been 2493. Or if we get about 2561, we're going to be looking at an activation, a strong signal to the upside. If we come down to this 2479, you also see that the weekly buy 2 coincides with the daily. And so this is another harmonic level that we're looking at. And you want to see the price synergy reaction after the completion of the target, and wait for the close using the 15-minute bar to activate the trigger points. So we'll let the market pretty much guide us here. I want to share with you my latest Associated Press report that I published here in Seeking Alpha. Gold, 1970s, bell bottoms, and inflation are back. Summary. The 10-year bond yield is falling in most developed countries. The U.S. got up to almost 147.70. It's at 157 now, actually, since I wrote this report, obviously, as I showed you earlier, which caused the stock market sell-off, and gold and silver came down to levels where we are. The market is afraid that interest rates rise, gold will collapse. It is a contradictory argument because interest rates are rising because of a fear of inflation. The Fed may cap the 30-year bond rate, which is where most of the debt is located, which is explosive for precious metals. The 10-year bond yield was falling in most developed countries. Switzerland and Germany are in negative interest rates on the 10-year bond. The highest yield is in Australia, which is about 1.75%. That's the highest interest rate being paid right now on a 10-year bond. Therefore, there is a lot of money going to Australia into their bonds. The disparity between Germany and Australia is about 2%. The U.S. got up to almost, again, 1.14770 a few days ago, which caused the stock market sell-off. And gold and silver came down to the levels where we are now, with gold at about 1,700 and silver at about 26 when I wrote this report. Given the tremendous amount of debt now, any rise in interest rates is going to affect the ability of countries and others debtors to pay. The Treasury, therefore, is under tremendous pressure. We may be moving toward higher interest rates. Given the huge amount of stimulus entering the markets, the market is saying that it's going to be inflationary, which is why interest rates are beginning to rise. Commodities such as wheat, soybeans, crude oil, and corn are all rising rapidly. Bitcoin also is up significantly. The commodity index shows most commodities are increasing in price. We are beginning to see a commodity bull market as a result of this aggressive monetary policy. The market will need more stimulus than they are offering right now. We still have high unemployment rates. Many companies are out of business. The damage done is still coming to light. The market is afraid that interest rates rise, gold will collapse. It's a contradictory argument because interest rates are rising because of a fear of inflation caused by supply chain problems. However, if the economy gets going again, demand may outstrip supply and lead to price inflation with more money chasing fewer goods. As we print more money and inject it in the economy, prices will rise, including gold. Already we are seeing a shortage, such as 1,000-ounce silver bars, which are used for industrial purposes, gold, and various essential chemicals used in medicine, not to mention the vaccines. We may see a stronger than expected economy igniting pressure to raise interest rates. That will put pressure on the Fed, since they know that if they raise interest rates, debt payments will rise considerably. Unless they take control of the yield curve, the Fed may cap the 30-year bond rate, which is where most of the debt is located. If interest rates even rise 1%, on the 30 trillion in debt payments become extremely difficult to make. No matter what they say, the Fed must keep interest rates low or even negative to finance our way through this record debt that we have while managing the pandemic. The situation is similar to the 1970s when inflation rates hit 14% in 1981 after the U.S. went off the gold standard. At the same time, the U.S. dollar collapsed against gold more than 90% in purchasing power. That exploded to record levels, and gold ran up to new highs. Gold and silver. We had another session of short selling with the average price of about 26.56. We came down to right into the variable changing price momentum indicator level of about 26.13. We're also getting a lot of volatility in the silver market. The paper and cash markets appear to be diverging, with a shortage developing in the cash market. Silver is at bottom and testing a lower level of support. The VCPMI is identifying that. And though there is an overwhelming bearish sentiment in the paper market, silver has come down to an area of accumulation of supply. According to the VCPMI is based on the reversion to the mean. It identifies daily, weekly, monthly, and annual averages, prices, as well as extreme levels above and below these means. On March 2nd, silver came down to 25.82 and then reverted right back up. It tested the previous low and showed that 26.13 is an area where buyers are likely to come into the market. The weekly buy one level is 25.75. The low was 25.82, close to that level. With 10%, within 10%, which is what we use as a rule of thumb, therefore it is confirmed that the market has reversed. Today we see another test of this level. The price came down and we found more buyers than sellers. Therefore, the price is reverted back up. You don't have to listen to all the chatter in the media. We just focus on what the market is telling us through the VCPMI. All over the internet is news about the short squeeze in gold and silver. The price came up to 30.35 on February the 1st on the news of the short supply. Then the market discounted the news and returned to its equilibrium price, or mean. Anyone who bought at the top got slaughtered. Do not follow the herd. Do not listen to the Main Street media. Experts in the media talk about how gold and silver were in short supply, yet they went down. Instead of listening to the chatter, focus on what the market is telling you. The markets are contrarian by nature. They do not go the way that everyone says they should go. Markets tend to go where no one is. Even after this correction, gold and silver have never been so bullish. Use corrections to increase your long-term long position in gold and silver. For silver, the daily VCPMI by one level is 26.13, and right now below that level, the weekly by one of 25.75. The daily by two is 25.39, and the by two weekly is 24.79. These are the levels that we're dealing with right now on the weekly here that I pointed out a little early here. And so we pretty much are catching up here with the current market condition. Once again, in silver, that is telling us that a close about 25.61 now would activate a bullish daily signal in above 75.25.75. You're getting the weekly buy trigger point. The gold market is trading above the weekly buy signal of 1694. And once again, we activated a buy trigger right here. We activated a buy trigger here, and the target completed right above it. Came down to test that level. Right back up again to close above it, activated another buy trigger here. The target was completed again. This is tremendous volatility when you're looking at the market trading, $10, $20 ranges like it was $2, $3. So I think this is what I mean by this is just the beginning of what could be a very, very exciting market here for precious metals, and we could be unfolding a reversion to the mean, so to speak, above 1700, actually all the way up to about 1780. The E-mini S&P as well, it looks like it has digested this short-term aberration of interest rates on the 10-year rising here. And it's reverting from about 37.20, which was the low. We're looking at 156, 157 on the 10-year note. And that's pretty much what is causing this bit of a strength on the US dollar, which is short-term affecting the price of gold and silver. If you remember back 2016, 2015 was the first time that the Feds raised interest rates a quarter point. And that was the beginning, pretty much, of the bull market and the gold market. So I don't believe that that relationship is valid anymore, dealing with the current markets, particularly dealing with the tremendous amount of debt and interest rates actually leaning towards zero or negative interest rates, which is what I believe we're headed for. So this is where we are here, trading above 1694 is a weekly buy trigger. It has completed the target a couple of times, and now we're waiting to see if it's going to come down again to activate another signal, because when you complete your pattern, you go neutral. The market comes down and it activates another signal. That's when you activate the trigger point. If you want to go back in, you wait for the signal to activate the trigger point. You don't go back in right away. And so this trade, this pattern has completed 2 trades, and now it's neutral. When you complete your target, you go neutral. And then you wait for the highest probability trade, and that is essentially the market to come down to the buy one level, or even the buy one daily level, or go through the average price, close above it, and activates the target above of 1715. So things have gotten pretty quiet here, and we're in a neutral position here as far as the day trade is concerned. Things just slow down quite a bit here. You can see even by the volume just coming down here, slowed down quite a bit. Most of the other markets, most of the other derivatives are also very, very quiet. Most of them are in red, obviously, but very quiet. GDX is down 31. The dollar index, slightly lower. I think that the gold market is exhausting. It's exhausted down here. You can kind of tell the energy slowing down, some of the short seller pressure, and if you look at the at this trend line here, trend line support of this downtrend channel that has been built since the high were made. We've come down right into that level that coincides with the codes indicating that's the strongest, most probable area that you're going to find buyers. And I think if we close above 1701, we pretty much are going to confirm that to be the case. So there are a couple of different indicators down here that are confirming that. We want to see green bars here from down here. Ideally, we want to see big green bars to the upside. Just be patient. I think the market is going to pay off big time if you're long. Just be careful about taking over leveraging yourself. That's very important to make sure that you stay in the game until the market will do what it's going to do and the prices will adjust to where they need to go.
Intervene.
The gold market is activating a buy trigger point. And if it closes above 1701, there we're looking pretty good. So 98 trading last, and let's watch the market here come to us. One of the things that I want to prepare you for, to all of my traders in my trading room, prepare for high volatility. And those listeners, that come to my live show here every day, prepare for extreme volatility here over the next couple of weeks, particularly. I think the strongest rally is yet to come. And I think these corrections, these anomalies are just incredible opportunities to continue to add to your long-term position. Let's put gold and silver here on the same chart, on the same board. And we can compare the way the charts look. Lots of volatility. You can see the ranges here. Just the supply and demand exchange here is just very interesting. As the market comes down here to this zone, again, where the VCPMI identifies this to be the strongest, highest probability area where you want to be accumulating or you want to be looking for confirmation of a reversion up to the upside, it would be from this level. The levels in blue. And what you see here is for a couple of days now, we've been stabbing into this area and reverting back. What we want to see is that the demand down here overrides the supply that's coming in here, and we begin to see the buyers take over the sellers. You can see more clearly the signal being defined on the 15-minute chart, which is the chart that I use for executing purposes. You can see here on the gold market trading above this is the channel, the descending channel trend line support. One other comment that I want to make here before we go here is that when we analyze the Fibonacci retracement in the gold market, that we've come down to complete what it's called a 61.8% golden ratio Fibonacci retracement. This is the second time. The first time was March the 4th at 1683. The other one was today when we made a law of 1692. $1683 was the low, 83.80. So we've tested the golden ratio Fibonacci retracement of 61.8%, which is the 1685.2 level. And this ratio is used to identify the completion of the previous move, that the market can correct up to 61.8%, and in some cases 72% of the whole move. Since 2089. And this is what's created this incredible pattern, this channel here, that I believe is a descending wedge. And the breakout point from this wedge is 1810. So on the bigger picture, for those long-term traders, a close above 1810, 1807 is going to basically confirm that the market is on the way up. It has completed all of the cycle bottoms, and pretty much the next challenge is going to be testing the high of 2089. Short term, we're looking at a rally above 1701 to confirm and validate pretty much that the short term bottom has been completed. Very important time, very important pivotal levels that we have, and a tremendous opportunity based on the fundamentals and the anomaly that we have in the cash market in relation to the futures paper market. Prepare for high volatility and manage your account accordingly. Thank you once again, everybody, for the opportunity to chat with you here this morning and show you this the application of the variable changing price momentum indicator in a real environment. Take care of yourself. Have a great trading day. We'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Folks, John